I'm Amy, Head of Learning and Development and Support at Trade. Welcome to another Thursday session. We are very excited to have you here, where we're going to be talking about the evolution of the tools within the credit space. So we're going from ledgers to AI, and how did that, what was that progression look like? Some of you on the call were part of it at that point in time during the ledger stage, and some of us were not yet around. But we're going to be taking you through, how has the credit space evolved? What are we doing as credit teams to make sure that we're keeping up with the different trends, and find out, where do we sit today? What do we do now? Where are we going to go from here? So I'm just going to share my screen with you and we'll begin. And of course, at any point in time, you're welcome to raise your hand, and we will gladly unmute you so that you can have a chat with us, or post it into the chat bot, and then either myself or Neil will be able to see it. Unfortunately, Martin is on leave today, which would have been perfect because he was around. He's going to be very sad that I said that, but he was around for most of these. And so we'll go through that together. Okay. So I'm just going to open up my side here. Sorry. Okay, hopefully you will see that coming through now. Nothing yet. Okay, there it is. Okay, so let's begin. So first and foremost, the problem with traditional credit tools that we've always experienced is most businesses still manage modern risk with outdated methods. And we see that every single day when people are calling in and saying, oh, but this is, we didn't get this information, such as a trade reference, what do we do? And the environment has changed and the tools often haven't. So this is something, again, we see all the time where people are still using the same old processes, but things don't match up anymore. So let's go through what we're going to be discussing today. One is the evolution of trade credit tools, South Africa's reality, so that was bank codes and Poppy, why older methods struggle today, the digital and intelligent platforms, modern decisions, and practical implications of that. So let's go right into it. So why credit decisions must evolve to survive. So most businesses cannot operate on cash alone. Credit enables scale and relationships and competitiveness. But extending credit is also an extended risk. So the more we extend, the more risk that we put ourselves at. So the tools that we use to manage that risk directly affects the profitability, the liquidity, and the survival of our business. So every decision that we make impacts one of these different areas within our environment. And for those who don't know, I made a little joke about a sundries account. I remember when I was studying accounting at school, won't say when, and we had to learn about, putting those miscellaneous spends into that sundries folder within our ledger, which no longer exists today, or hopefully I would say it hopefully doesn't exist today in your environments as well. So let's talk about the first era, which was the ledger era, okay? And early trade credit was deeply personal. You extended credit to people that you knew and not companies that you researched. A lot of the time, because people were, we were in a very non-digital age, you actually had to get to know that person. So you extended credit to the people that you knew, and risk assessment was based on reputation, community knowledge, and experience. Ledgers were revolutionary at the time, and that enabled businesses to track obligations instead of relying purely on memory. So it was really obligations and trust between people that we used to enable them to trade on credit. But scale was limited, obviously limited to the area that you stayed in, as well as the people that you knew. So your scale was very, very difficult. But as businesses grew and trade expanded beyond the local markets, this model began to fail. So you could no longer rely on personal trust with partners thousands of kilometers away because you didn't have access to be able to see them on a regular basis, to be able to communicate with them as well, short of sending potentially faxes were around at that point in time in the 1900s. And this is when we are looking at that period of time. So this meant that the businesses that we were looking at was very limited to the space that they were in and the area that they were in. Okay. And then what happened was we went into era 2, which was also around the 1900s, but a little bit later on. And this is when we started to see the rise of credit bureaus and scoring. So this was a major turning point. Decisions moved from gut feel to evidence, okay? And for the first time, businesses could evaluate companies that had never met. So it wasn't just, to your specific area. You could now reach companies you had never met. And this enabled us to also do some global trade or cross-border trade to accelerate our businesses dramatically. So credit became institutional rather than personal. So now, again, we've lost that personal trust that we had with the people that we knew, and now we're doing business with people that we didn't know. And risk could then be priced, monitored, and compared through the bureaus as well. And this laid the foundation for the modern credit management to where we kind of are today. And that's where we see the change starting to take place. So from our original trust and ledgers and just writing down, okay, so-and-so promised to pay me on this date. And then, if they didn't, you could take a little stroll across the road and have a conversation. And now moving into a digital format where we are tracking and seeing exactly what is going on. So this was quite a big turning point for us to rely on the first set of data, if you want to call it. We then moved into the spreadsheets area. So the spreadsheets revolutionized, and I remember actually when Excel came out, just shortly after DOS. And so for those who don't know what DOS is, everything was orange and gray, and it was crazy. Okay, so here you had the revolutionary of now taking this ledger that you used to have, which was a physical book, and now moving that into a space that could do calculations for us. So spreadsheets, they democratized analysis. So they now were enabling us to put this information into a place that would help us with our calculations. So suddenly anyone could perform complex calculations, even me, once you learned what those formulas were. And, by the time they also introduced the new risks. Okay, so errors, version controls, issues. So maybe you were looking at last month or yesterday, and then we've made changes. And this then became a dependence on individuals. That's when teams started to grow. Those credit teams started to grow because now each person needed to manage their own work, and this could then sit in that spreadsheet area. So spreadsheets replaced the traditional ledgers, but in a digital format. So it's still with a ledger, but now we're talking about it being onto a computer and those calculations coming in. It also meant that we could start using internal data for tracking, because now we're using these ledgers, we're automatically calculating. We can now look month on month, what are we doing, where are we going, how are we growing? And that used to, that became a very important way of judging behavior based on data. And that happened around, 1999, 2000. And so, this is when knowledge became portable but fragile as well. So it's a very interesting era. Then came the early software platforms. So that was also like around 1990, 2000. And this was the digitization of different kinds of, CRM systems, and automation actually begins. So software started to formalize this process. Approvals could now be tracked, limits could now be monitored, exposure could be measured in real time. But most systems were still reactive. They were not proactive. They were letting you know that had happened already. And they recorded all this information, but you would still be able to now start tracking past behavior and not yet future behavior, which is the predictive side of things. So it was a great way for us to start monitoring and managing our existing debtors books. And it's where, workflows were now introduced, reporting was now improved, so people could give you a physical report and say, this is where we're seeing potential risk, this is what happened last month. If we're going to calculate our expected credit losses, these are the customers that we foresee, and it could all be now saved into a platform that all of your team could now access. And that was the birth of those early credit software systems. Then came the platform age. So this is an era 4. This is around 2010. We started seeing integrated platforms. So credit management became part of operational fabric of the business. Okay, so it was one of those things that you needed in order to now run your business. It also meant that information flowed much faster and the customer's experience improved. So because now you can see and track everything that's going on, but obviously the more that we add in terms of systems and the faster that we move, this adds another layer of complexity. So it means that we have to work faster, we have to onboard faster, we have to provide services faster, because now all of that information has been consolidated and it's easier for us to interpret. But it also meant that we could now see real-time exposure. And this is very important to say, now we can see how much of our stock is sitting outside of our business and how much money are we waiting for us to be able to get that money. Okay. I'm guessing no one has any questions. If you were around at this point in time, you can also add a comment. Then came bank codes. So this is a South African thing, and South Africa, before widespread digital credit data, I just went purple, was one of the most trusted sources of information. And this was the way that credit departments would be able to assess affordability. So that affordability, sorry, I'm going to have to switch off my camera because I've gone purple. But one of those areas was the credit department would now request a bank code. And essentially, it was confidential opinion of the customer's financial health. So we started looking at how much can this customer afford to pay me? And this provided us with reassurance that the business was solvent, it was active, it was credible. These bank codes were not detailed financial disclosures, but they were structured signals from the bank's relationship of knowledge. So if somebody gave you a bank code A or a bank code B, it gave us confidence to know that this person could afford the credit that they were requesting. If they got something like a D or worse, this raised caution and triggered tighter terms, or for us to choose not to actually trade on terms at all. So for many credit teams, this was a cornerstone of a risk assessment. Importantly, like bank codes gave us external trusted perspective. Okay, they helped us to validate that the business existed and operations were normal, and that they maintained acceptable financial discipline. Okay, and this was especially useful when dealing with unfamiliar customers, because now remember, we're in that stage that we're talking to people that we didn't know before. And so we needed to have some kind of validation on their financial status. But most banks no longer provide bank codes to third parties. I remember the day it happened back in 2021. I remember it was in July when FNB came to light to say that they're no longer going to be providing bank codes due to this new POPI Act that had not yet been released, but it was coming. So shortly after that, the Absa Bank followed to say that they were no longer going to provide those bank codes to third parties. Standard Bank and Nedbank still do provide bank codes, but they require explicit consent. And explicit consent literally says, I, business ABC, give credit bureaus the permission to request a bank code on my behalf directly from my bank. So it has to be specific around bank code information. Okay, and so as a result of this, traditional bank code system was largely just disappeared overnight. So now, a lot of people were then stuck because some of the banks still provided limited confirmation, but only with formal consent and stricter controls. And this process is slower and less reliable than before. But really, even a bank code was really a snapshot. It was does this person have this amount of money in their bank account over the last 30 days? And then they would say yes or no. But they didn't look at, where was that money coming from? When did that money come in? It could have been that maybe they just got paid by all the suppliers, but they actually have huge costs and all of that money is going to be gone tomorrow. They didn't manage that risk at all, but it did give us some kind of indication about financial stability. Okay, so we didn't abandon the bank codes entirely because they stopped working, but we abandoned them because the world also changed. So we could now say that, things are different, people are different, processes are different. But it did take a big knock in the, in the space of credit and credit onboarding and decision making, because now we were sitting at a point to say, well, what do we do now? How do we assess affordability? How do we make sure that we are not recklessly lending? So it did throw the credit team into quite a different realm and pushed us into places that we weren't comfortable with. Next, what happened was COVID. So COVID took place, and trade references, which is what we used to rely on to assess behavior and understand who we were now, getting to know our person. Trade references was something you could pick up a phone and phone a business and say, hello, I see you trading with Neil. What kind of debtor is he? Does he pay on time? What kind of credit limit does he have with you? And the person would happily tell you about Neil and Neil's trading with them. And that gave us that other indication that we were looking for, which was behavior. So the bank codes gave us affordability and trade reference gave us behavior. Then COVID came and trade references became very difficult to obtain. So companies are, now working remotely and people are giving cell phone numbers, and it's really difficult for us to be able to say, this is who they say they are and not somebody's mother, brother, sister, uncle, or they do actually even work at that company, or sometimes they only give you the 3 suppliers they do actually pay, because without those 3 suppliers, they would have nothing. They would have no trading. They would have no way of making an income. So companies are now, and then came the POPI Act included in that, and companies are now increasingly cautious about sharing information about customers. So there were concerns about breaching confidentiality or data protection obligations, even though POPI actually has nothing to do with this, because you're not talking about the individual, but you're talking about a business, and that actually does not fall into the realm of POPI, but it became a crutch that people used to use. Sorry, I can't tell you any information due to confidentiality and the POPI Act. So this put us again into quite a predicament to say, what do we do now? Because we can no longer rely on the 2 things that we've been using for thousands of years, okay, hundreds of years, to now make a decision and to say, where are we going to go from here? And so trade reference information is still used today. Some companies still use it, and again, and we'll come to that in a little bit in terms of, moving into that realm of change and data and analytics as opposed to old school methodology. Okay, so that is where the trade reference information really fell apart around that COVID period, and then around the release of POPI. I'm going to see if I can just get my camera back on here. Okay, so then what came was the intelligence and AI and predictive credit. So that's sort of where we are today. And that goes without saying that we are living in an age that is very, very different to where we were before. There we go. Now you can see me. And they, the tools that don't just record risk, that is today, we don't just record the risk, but we anticipate it. So now we've moved from that stage of being very reactive to being more proactive. So patterns and payment behavior and macro signals and operational data can identify deterioration before defaults occur. So now we're saying, we want to know, before this customer is going to not pay me, what things can tell me that this is what's going to happen. Okay, so that's where the shift in data and analytics and interpretation comes in. So this shifts the credit from a reactive control to proactive protection. If we are quick at looking at these different things and we make sure that we are proactively monitoring our debtors, then, this is This is how we can avoid our customers not paying us or extending credit to customers who are not going to pay us, okay? And this is one of the reasons that modern credit platforms emerged, one being TradeShield. And it's not a luxury anymore, but it's now a necessity to say we can stay in the past or we can move on to the future to enable us with the right tools of where we are going. So when traditional signals disappear, organizations must now rely on new forms of insight, and we have to shift and grow and change and move towards, looking at behavioral analytics because we can no longer get that trade reference behavior information, early warning signals about non-payment, dynamic limits. So we can now offer people multiple different terms and different limits to say, on these products, you can have 7 days from invoice, and from these products, you can have 30 days from statements. We're able to manage that now, okay? And of course, AI does bring its own set of risks that we are no longer relying on people, we're now relying on systems. And that can be quite scary because it still actually requires a human interpretation to say, what should we do? Where should we go? And the best thing I could do was a navigation analogy. So today's tools don't just, like we want to go and say you would never actually go out into the fields today and you would not walk around a new city with a piece of paper and a map book. And for those who are too young to know what a map book is, then we can definitely find a picture for you, I'm sure, on the internet. But you wouldn't go with your map book. And, so why would you manage modern risks with outdated tools? Now you would go with your phone, you'd find free Wi-Fi or have your roaming on, you'd use your Google Maps or your Waze, and you'd find yourself around a new city, even if you didn't even speak the language. So we've gone from those hieroglyphic days, and we've modernized all the way to technology today. So why should credit be any different to the entire world is changing, and therefore we also as credit teams need to change. But we also have to take into consideration certain things, and we do have to be careful around, for example, the implementation of POPI and data privacy. So the Protection of Personal Information Act, that is what POPI stands for, it changed how sensitive information can be shared. And this could be your individual name. Financial data is considered highly confidential, but it does not count as POPI. And the reason for that is POPI is personal protection information. So if we're talking about the director's personal bank accounts, that falls into POPI, unless he is a sole proprietor and he is going to be trading as himself, then again, it supersedes that POPI information. So financials are not confidential due to POPI. They might be confidential because somebody is using that as an excuse not to give you their financial information, but it is not to do with POPI. But sharing names, telephone numbers, personal addresses, that information we do need to make sure that we are getting POPI consent, making sure that we've covered ourselves should they come and do an audit on us. So institutions must ensure that they have all the lawful grounds and explicit content before disclosing any information. So as a recommendation, we do say that if you do not have POPI consent in your credit application, you definitely should end this call and call your lawyer and go and add it to make sure that you do not land up in a situation where you've now captured someone's personal name, telephone number into your system, and you did not receive consent for that. So we do have to adapt. So why do the older methods, struggle now? We've now got much higher volumes. Faster decision is required. We're in that age of we want it and we want it now. We don't want it yesterday. We sent you something. We need the answer now. We're in that age where everything is now. I see it even with my children. Can I have juice now? As if I was just holding juice in my hand. And complex supply chains, things are very different. Businesses are different. Now they have subsidiaries and divisions and companies based overseas with the same registration number, but international registrations. And so we've got a lot going on that we need to ensure that we are working with. And obviously all of these changes increases our risk and volatility because we're dealing with lots of complex things. Okay, we're not just talking about, the day-to-day and the guy next door. So the operating environment has changed so dramatically that manual or fragmented tools cannot keep up with modern speed and scale. So if you're still wanting to use your ledgers or even your Excel spreadsheets, you are outdated and you are going to miss out. And at some point, you're going to not be able to manage with the amount of work and complexity that comes with the change within the credit space. And it's very difficult because a lot of the teams have been in their roles for many years. And if you look at the time period between 1999 to where we are in 2026, which is really not that long, the credit space has dramatically changed. I mean, I know a lot of businesses have dramatically changed, but specifically how we manage debt and how we manage credit, all of that has changed dramatically. So now we need to say, because of where we are right now, we've got a lot of tools at our disposal. So we can look at payment behavior in different ways using data and analytics. We've got financial statements, and we can still look at bank statements. So you would then be able to interpret, what money is coming in, what money is going out, when is this money coming in, where is it coming from? In other words, like, are they constantly being funded by the directors to keep afloat, or are they actually creating revenue? And then we look at financials and we look at their ratios and say, yes, are they turning a profit, but what did they do last year versus this year? And if we give them credit, how can we help this business grow? Those are things we want to talk about as well. And if we help this business grow, we of course help our economy grow as well. And that obviously has a knock-on effect across the board. We've got external intelligence, so this is coming from everywhere around us. We can now log on to different platforms, one being TradeShield, but you can log on to, the CIPC website, which is free. You can go to the SAPS website. You can look at sanctions lists. So there's a lot of places for us to get information. Judgment information is shared via bureaus, and statutory information as well via bureaus, which still exist today. And a lot of companies, depending on your size, would then rely heavily on that information as well. And all of that together correlated can then become what we use our, day-to-day objections. So here's some old school objections that we've come across to say, like, we've managed fine with our technology until now, or relationships matter more than data, and technology removes the judgments that we can make. We don't talk about, we're not meaning financial judgments, but your personal judgment. And you're right. But at some point in time, you still have that relationship level that we think should still always be there, because you are, one of the 7 C's of credit is, knowing who we're getting into bed with, who are we starting this partnership with. So we want to make sure that we are, getting to know our customers, not just their processes, but who they are, what they're like, building that relationship, because people buy from people. And so you want them to continue to buy from you. You want them to be able to grow with you, because we are all in that business. We're in business. We're not here to make friends, but we still want to make sure that we have that personal relationship, that personal touch. And, with regards to data, it doesn't mean that because we now have data that we have to forget about the person. We definitely don't. We want to make sure that we're putting the two together. So we're being wise and we're being kind together. And so technology does help us, but it doesn't take away from where we are. But I know that a lot of people say, well, it's working perfectly fine the way I am right now. And here's my stack of credit applications that I have on my desk over here. And I'm going to go run to this person's office in a few minutes and give it to them, and then accidentally drop a piece on the way out, which was the signed terms and conditions. And, then we may have a frustrated customer. So, we want to move from being reactive to proactive. And I know that this is part of the theme of all the discussions we've been having throughout our webinars this year. So the role of the credit, of credit is evolving from enforcement to insight, from technology. It frees up the teams to focus on judgments rather than admin. It makes sure that we're focusing on collections. It's making sure that we're ensuring that our business cash flow is good so that we can grow as a company. So we want to go from chasing overdue accounts to early intervention to preventing problems. That's where we want to go. We want to go from the old school way all the way through to being proactive and predictive. So what about modern credit teams? What do they need? So they need tools that are going to amplify their capabilities, but people still need to make decisions. So that is why it still needs to go through a process or a approval matrix to say there still needs to be human intervention to decide, there are other factors that systems can't take into consideration. For example, personal relationships. sometimes it could be that the business you want to onboard, they're going to pay you slowly, and you factor that into your billing. So there are going to be bad payers, but being associated with that company, and your company will then skyrocket you to grow into other areas. So you may want to take on that risk. You may have credit insurance to allow you to take on that risk. So modern teams need to have that data literacy. They need to have discipline in their credit policies. They need to be able to cross-functional collaboration between different teams. So finance, sales, and credit all need to be able to be on the same platform, on the same team, to be able to see what is going on, and then have that strategic mindset, which comes from that collaboration, to say, we're all in this together. We all have the same goal, which is earn a salary, grow our business, make sure that our business is still in existence tomorrow so that we can continue to grow and become the next most important business that there is. And we're only going to be doing that by keeping up with the trends and keeping up with modernization and using those tools to our advantage. But I would say, combined with some of the things we've learned from history, to say, we still want to make sure that we have that personal relationship, that we're building that relationship with our customers, because repeat business or lifetime value is also very important. And that's part of our sales metrics, to say, yes, we have our cost to company, or they refer to it as CAC. And that is the cost that it takes to acquire a new customer. So they have that. And then obviously that customer then becomes profitable after a certain period of time. And then we've got that lifetime value. And of course, from lifetime value, we also want to move into that growth strategy. So how we can get more from that particular data, but also that then enables that data to also have the same from their debtors. And you can see that knock-on effect. So again, I've said this before, I think I said it only last year, that as credit controllers, we are not those kinds of people that just come to work and our job is collections. We have such a huge impact on the growth of somebody's business, every person's salary that gets paid from your business, as well as the people you trade with. And essentially, that is the building of an economy. And so when we come to work, we are directly linked to building the economy, both within our country and other countries if you deal with cross-border or international businesses. So no small task, no small relationship. So that leads us to where to from here. Where do we go? What do we do? Which path are we going to go down? We have that fork in the road to say we can continue on the path that we're on, or we can choose to move forward. So the future of trade credit is already here. We're in that age with AI and data and analytics. And that, that will lead you to changes, or you can resist it. Lots of people can and do. But the world is going to continue to evolve, and we need to evolve with it if we want to keep up with those trends, if we want to be able to be competitive in our markets, to say, if that person is going to onboard a customer in one day, we're going to need to be able to do it in half a day, so that we can ensure that we get the business from competitors and make sure that we have that advantage. So this is where we are sitting with where credit is today. Hopefully it was a bit short, sweet, and to the point, where we are able to tell where do we go from here? What do we do, and how do we do it? If you are not a Trade Shield customer, please don't panic. You can always join us later. But if you are a Trade Shield customer and you are obviously going through this process with us and growing with us, then we thank you for your support, and we are excited to be a part of that journey.
Join us every Thursday from 10 to 11.